Right, hello everybody. This is Adrian here. It's the 11th of November 2019. I hope all is fine and well with you all, wherever you are in the world. So this is the live podcast that we're doing right now. It's just me today, so I know usually I have a guest with me, or at least our CEO Jerry, but Jerry is actually he's at base camp right now, Mount Everest, and he's in fact just on his way back down the mountain now. So it's just me today. Last week we had someone from a regulated broker join us, Gurpal Singh, talking about the topic of how to choose the best broker for you. But today what we're going to do is go through the usual stuff, talking about what's going on, what's hot in the market right now, what's going to be impacting the markets for the week ahead. And also the main topic to today is the stock market ready to crash? So we're going to get into that, and I'm going to talk to you and demonstrate to you a pretty cool technique that I use really regularly to help me to identify timing with stock market trades. So that will be with a view to trading your portfolio, but also in terms of trading the indexes or the indices themselves, whether that's US indices, whether that's the UK market as well. Now, guys, we're still relatively young in the life of this podcast. So please, the purpose of doing this live and to have the questions and answers is so that you can interact in today's session. I've got to tell you, it was very quiet last week. Hopefully it didn't bore you all to tears with Gurpal. But if you guys can just type a quick hello in that questions box there. If you are on the live session, I'm talking right now, of course, just type hello, type yes, type something like that, anything really in that questions box. This is how you can participate. The whole point of doing this live and me talking right now at 12:32 on the 11th of November is so that you can interact, you can ask questions. If there's anything you're not too sure about, I can recap it, go over it again, and so on. Okay? Good. You seem to know where the questions box, that is significantly better than last week. And if you are listening to the recorded session, guys, you can always send those emails in to info@trend-signal.com. And there is also an exit survey at the end of this session, which will ask you to put a few questions in, topics for the future, all that sort of stuff. So good. So what am I doing today? Well, let's get into a little bit about what happened last week. Well, let's have a look at some charts, shall we? Have a quick look first of all at the euro. Really we saw a fall in the euro, well, relatively flat overall, but predominantly it was more of a rise in the dollar really last week. Fairly flat on the euro, fairly flat on the pound. Pound's roofing it today. Don't know if anyone's seen why we're rising today. Has anyone seen that? It's all down to, it seems like the Brexit party is not going to contest existing Conservative seats. They're only going to go after the other, or Labour or other seats that are in play to try and help, I guess, try and help ensure that Brexit does go through. So that's led to a very strong rise in the pound today. Interestingly, on the back of lower than expected GDP, preliminary GDP data already this morning, you would expect actually the pound to be falling, but it's that Brexit news, Brexit party news release that came out at about 12:15 with Farage talking there, which led to a big rise in the pound. Interesting to see how that comes over in the next few days there. But of course, for last week, we saw gold got absolutely battered as well, affected no doubt by the movement in the dollar and also that continued rise in the stock market, with the US stock market continue to move to record highs. With Thursday, let me just bring the Dow charts up for a second. We can see the Dow there on Thursday last week making it up to 27,700 odd on the Dow, another record there, record high close on the weekly, and it's looking like, well, we're a long way of the month left to go, but looking really strong for the month as well. Will it continue to be strong? We're going to talk about that a little bit later on. Certainly for now, the US stock market is very positive indeed. Is it time for a fall? We'll talk about that later. The DAX, of course, has also been very, very strong as well, really outperforming the UK market, in fact. And actually, the UK market's longer-term trend, the FTSE 100, it's actually turned down. The monthly trend has now turned down, but the DAX market is actually incredibly strong, even with some really quite weak data still continuing there. With Germany, the manufacturing sector is in clear contraction mode. We saw that in recent data there. Last week we saw that with the ISM data, I think it was, coming through there, again, clearly in contraction mode. But what this is doing is, I guess, it's pushing the likelihood of more asset repurchasing in the Eurozone, because they can't really go any lower with interest rates, really, can they? So that really can be only a good thing for stocks. So maybe it is the case, notwithstanding today's pullback a little bit there on the back of China trade talks there. It could be the case that shrewd investors are really just attempting to get long early before any kind of asset purchasing kicks in, but that's assuming it's going to happen. Who knows? The fact is, you have to remember, when it comes to stocks, reducing interest rates is making stocks more attractive right now, as there's nowhere else for anyone to put their money. Bond yields are incredibly unattractive right now. They are dull, they're boring, there's not a very good rate of return. So what that means is that there's no obvious alternative for pension funds, hedge funds, the people with money, to put their money other than in stocks, where there is still actually value. Does that make sense, guys, to everybody? Let me know. That's why a lot of money, that's why the stock market has been rising the way it's done. There is value there, but it's because there's nowhere else in town. Interest rates are incredibly low across the world, which means that where you're going to move your money to get a better rate of return, it's all pretty naff either way you go, which makes stock a very, very attractive place. Dividend yields are still reasonable. You've talked about dividend cover last week. It's still great dividend cover as well from the profits that a lot of companies are making. So it's still all right. And actually, longer term, I am still a bull on the stock market as a consequence of the interest rate and where we are right now. But again, we're going to talk about timing in a second, because you have to remember as well, the markets do not just go up in a straight line. Remember human emotion, remember profit taking. The markets will continue to inhale, i.e. pullback, and then exhale as well. So the question is whether we're due an inhale where the market can pull back a bit, which will then give it the momentum and the drive to then push on, maybe onto new highs on that stock market. Who knows? We'll have to wait and see. But certainly timing when it comes against the trend. The longer term trends there, you see the arrows that we've got there? You see those arrows on that chart for the DAX? The longer term trends on these markets are very strong. We're up on the weekly trend. We're up on the monthly trend. Trend is your friend, remember. We're seeing similarly with the Dow as well. Longer term uptrends there. So to fight against those trends, you've got to be a little bit careful, okay? So we're going to be talking about that a little bit later as well. Just something that's going to help us with the timing, okay? And the timing of that trading opportunity. So it's a good session to be into today, guys. As for economic data last week, there was a few bits. It wasn't exactly a big week in terms of economic data. Last week, Australia, the Australian Central Bank, they held their interest rates at 0.75% as expected. And to be honest, not really anything happened. Not much of a move on the currency as a result. Guys, do you understand why the markets shouldn't change if the data comes as expected? Remember, economic data, the market is already factored in what is forecast. This is based on a poll of economists, okay? So what they're doing is they're saying where they thought the data should come in at. And the market is effectively pricing that data in. So we're expecting, let's say, an interest rate, no change, like we saw here on the Australian cash rate, okay, at 0.75. It happened to come in at 0.75, so they decided not to cut or raise rates as expected. Therefore, nothing to see here. It's as we expected it to be. The market will continue relatively flat. It is about when the data comes in that is different to forecast, different to expectations, that you will then typically see a reaction on the market. The more the data is away from forecast, the bigger the reaction is likely to be, okay? So that's really what it comes down to. And of course, what the economic data, why it's relevant is not because of necessarily the terminology or what's happening to the economy. It's more about it creates movement. You don't have to be an economist to know this. It just creates movement. What it then translates to is movement on the chart that you can then react to, that you can make trades from. But it is that economic data, the data that creates movement, because you have suddenly portfolios being adjusted because of the impact on interest rates and so on. Do you see? So what happens is we use this as a catalyst for market change, for changes in direction that will then generate trading opportunities on the markets that we can use the charts to identify to then pick up profitable trading opportunities. That's the way it basically works. People, it's very difficult to trade this itself and to actually, because you're trading off data that's already old. By the time you read about it on a Forex Factory calendar, it's already old. The market's already adjusted, the market's already moved. The way in which you profit from this is the reaction that happens, the speed of movement that happens after that, that creates momentum, creates movement in changes in trends, that creates trading opportunities. Do you see? So what we also had last week was US ISM non-manufacturing data. It was strong, which is typically good for the currency because it means that the economy is doing better than expected. So there we are, expecting 53.5. It came in at 54.7. So effectively, like I said, that'll be good for the dollar, which effectively means that they're more likely to raise rates and to slow the economy down. Guys, remember this, okay? Again, we talk about economic data. We talk about all these complex terms. If you don't understand what I mean, don't worry about it so much. I want to break it down a little bit. Would you like a real simple shortcut? I'm going to tell you right now to breaking this all down, okay? I'm going to tell you it right now. It's all based on interest rates, everybody. We all know. Do we all know what interest rates are? Give me a yes or no in the question box. I'm pretty sure you do. They're a pretty important thing for us. Okay, so remember, when you raise rates, when interest rates are raised, it means that people are more likely to save money and they're more likely to spend less. They're more likely to save money because of a better rate of return on their bank accounts, and they're more likely to spend less. If you want to slow the economy down, you raise interest rates, making saving more attractive, and then thereby you're going to spend less money there. Okay, so it's all about the impact on interest rates. Also, of course, if you have a mortgage, think about it in this way, in this simple terms, your costs will rise as well if they raise rates. So that'll mean you've got less money to spend. Again, if you want a stimulus, you want to stimulate spending, you cut interest rates to make saving a complete waste of time, which it is at the moment. That cuts your mortgage costs as well, and that gets you out spending and spending your savings. Does that make sense? Okay, so it's all about interest rates. The better, that's really what it does. Interest rates change in order to change and affect our spending patterns. Now, how does that impact on currencies? Do we understand how interest rates change currencies? Okay, so if the data beats expectations, this is usually good for the currency since it means that the rate is more likely to go up. They're more likely to raise rates. So in other words, if GDP, gross domestic product, the productivity, if you like, of the country, the economy, is better than expected, that means, oh, the economy is doing better, we probably need to slow it down a little bit. We're more likely to raise the interest rates, okay? So what's that likely to do? When you raise interest rates, that means that suddenly that currency has got a better rate of return because you could transfer money into, say, pounds and put it in on deposit there and get a better rate of return on that capital. So the more likely an economy is to raise their interest rate, the more likely it is that that currency will go up. You'll see it go up and shoot up in value. So typically what you'll see is when a data point beats expectations, it's more likely to raise rates, which means you're more likely to see a price rise on that particular currency. Does that all make sense, everybody? Give us a yes or a no in that questions box, if indeed you're on that the live session there. Yeah? Does that sound good? Does that make sense? Yep, lots of yeses coming through. Is that something you didn't already know? I hope so, because the whole point of these podcasts is to educate and give people a bit more understanding about what it is. Does that help us to trade? Not necessarily, because actually all of it is then translated onto the chart, guys, okay? Crude oil inventories, of course, relatively flat as they have been, but on the week for the price, but of course they fell sharply on those inventories. Price fell sharply on crude on Wednesday as that supply was higher than expected. We're expecting a 1.9 million increase in barrels of production. It came in at 7.9 million. That's an increase in supply. That's going to cut price, okay? That's generally the way we're simple supply and demand, guys. Okay, anyway. UK, we kept rates the same as expected again. What was quite interesting about the interest rates there on Thursday this week, of course, we're expecting 9 votes. The 9 people on the Monetary Policy Committee, we're expecting all 9 of them to vote for a no change. That means no one voting for a rise, no one voting for a fall, and 9 on a no change. Here we had 2 people voting for a fall last week. So actually, we're starting to get those people talking about a cut in rates. Remember, what will a cut in rates do? It'll add stimulus. Why is that going to be important? Well, remember, if you think about the data this week, why would you want to stimulate the economy? To boost growth, okay? To boost spending. And actually, as our GDP came in today, we actually saw that lower than expected. That's going to fuel their desire. That's going to fuel the MPC committee's desire to cut rates, to get us out there spending. No point saving if they're going to cut rates. We're going to have more money if our mortgage rates are falling, so we're going to get out and spend, which is, likely to lead to a fall in the pound. It didn't really move a lot today. The rise in the pound today has actually been on the back of that Brexit party notification there about not contesting Conservative seats, okay? Anyway, hopefully that's all relatively interesting, and hopefully you're all still awake. So what about for this week? Well, this week, of course, we had, it was Armistice Day. Well, it's really today, isn't it? There, which yesterday I celebrated that with my wife, my kids, because we had the Beavers and Cub Scouts parade, so we're off doing that, which was great. But actually, we had a bank holiday in France, bank holiday in Canada, bank holiday in the US, and what that often makes is that can make the stock market a little quieter than normal, because if the US, all the US traders are, having a party somewhere, what's basically going to mean is there's going to be less trading done, less volume traded, thinner market. That doesn't mean, however, that there's not likely to be some decent movement today. We've already seen stock market taking a bit of a whack today. We've already seen the pound up 50 to 100 pips. So, there is still the potential for a lot of very decent movement, even if there's a lot of bank holidays kicking around. And actually, what's quite interesting is, sort of anecdotally, that when the market is thinner, you can see bigger moves. Why can you see bigger moves on bank holidays? Because it takes less volume to push the price to change. Because if there's less people trading it, i.e. if it's a thinner market, then actually the market's more likely to move further, more likely to move faster, because less trading is required to move it there, okay? Because there's less what we call depth of market, okay? So what's quite interesting about that is that very often, and anecdotally I'm talking about here, so no guarantees to anything like this, of course, but anecdotally, I've seen many times where if you've got a US bank holiday, that the Europe and the Far East market puts on quite a big move. So in other words, if we put on a big move while the US is celebrating, whatever they're celebrating, what we often find is that that move is really eliminated by the time the American market comes back in on the Tuesday. So what you'll often find is that it's a bit strange actually. So let's say, for example, you've got the market close here on a Friday, you've got a bank holiday, we see the Far East and Europe suddenly move up here on the Monday, okay? What you often find is by Tuesday lunchtime, the market often then drifts back by about 2:30, the US stock market rise, and then the market then does its thing after that. It's almost a bit like the Americans saying, hey, not on my watch. We're going to you don't dominate the market, we dominate the market. So that market movement is often eliminated and naturally drifts its way back to 230. Is that standard? That happens a lot. It's not certainly every time, but you can have a look back at bank holiday moves, and it does happen quite a lot. It's quite interesting, actually. Will it happen come tomorrow? Who knows, really. But if you think about it, it actually makes sense, because as we move through to the US market, i.e. US time tomorrow, there's going to be all the Americans getting up. They're going to turn up to their trading screens and they're going to go, whoa, hang on a second. Why is this market up here? Why is this market down here? They had all their orders up here. They had all their orders down there. And the market is going to naturally drift towards where those orders are, because maybe they don't want to put new orders in, new trades in. So effectively, you often see that drift come back to that price, and then the market will then take it up and then carry on from, say, 2:30 UK time. That's when the US stock market kicks in on Tuesday. We'll see what happens, but it's always an interesting little pattern. Lots of interesting little patterns out there that can help us to trade. It does make for a rather more fascinating market from time to time. Anyway, I digress slightly, as I tend to do. Tuesday night, i.e. Wednesday morning, we've got the, this week this is, remember, we've got Royal Bank of New Zealand, got their interest rates decision there. Expecting a cut, guys, so expecting a 0.25% interest rate cut. So be careful with New Zealand dollar positions. If you're running those into Tuesday night, just be a little bit careful on those. Make sure you've got your stops in, or just consider those positions when whether you want to keep them running. A few other bits this week there that are going to keep your pencil sharpened. CPI, Consumer Price Index, that's inflation data on both the pound and also the dollar, so the US inflationary data. That's always going to be important, and again, that's going to have an impact on interest rates, because remember, it's all about the inflation that then impact or affect interest rates based on inflation. Do you see? So inflation's getting out of control, then central banks will use interest rates in order to control inflation. So inflation data is very, very important indeed, okay? The main difference is in the US, the FOMC, they have two briefs. Our brief in the UK for the Monetary Policy Committee is based on inflation. In the US, it's inflation and jobs, okay? So that's why non-farm payroll is so important in the US, because that is a massive impact on interest rate decisions, as well as the inflation data in the UK. Inflation data is very, very important indeed. Okay, so we've got that Thursday preliminary preliminary, couldn't say that word properly, GDP. That's at 7 a.m. on Thursday. Now, this is going to be actually relatively important, I think, because we could, or Germany could be pushing into a technical recession based on that. That's when you have 2 quarters of negative growth. It's at 7 a.m. on Thursday. I think that's going to be a quite big piece of data. It's only set as a medium impact piece of data, but actually we're expecting a contraction of 0.1%. If it comes in at 0.1% or worse than that, then that effectively means that Germany is in a, well, really would be in a technical recession, although it's preliminary GDP data, so it's not the final number, but it's certainly expected really to go that way. UK retail sales, that's about what we're spending. That'll be interesting on the back of GDP data as well. Where have we got that on Thursday there? US PPI, we've got Powell speaking as well there at 3 o'clock. There's quite a bit of big data announcements there coming up this week, actually, guys, and also retail sales here over in the US on Friday as well there. So what does this mean? It actually means movement. It means opportunity. What this means is that there's a lot of things that are going to impact those currency and stock markets. A lot of opportunity, a lot of movement that's going to come on the back of that. So it doesn't necessarily mean, oh God, retail sales are better or worse than expected. It's really about that can create movement. As the trends start to change, as the data starts to get better or worse, you'll start to see currency prices rotating. You start to see big changes in direction. You'll start to see turning points. You'll start to see trading opportunity. Do you see? And then it's how we pick up on that. That's all translated to the chart. You don't have to be an economics whiz to be able to benefit on the back of that economic data, because it's all translated into the charts, guys. So what will end up happening is, if the data is better or worse than expected, and it's consistently better or worse, you'll start to see changes in direction. Like we saw here with the Dow back here, you start to see those indicators, like are my indicators here, turning from green to red or red to green. giving us trading opportunities, giving us the potential to profit from that market change. Okay, so the question is whether, I guess, we've got the ability to spot those. It's all there, of course, if you know what to do. And before I actually get on to the main topic for today, God, I've been talking for 24 minutes already, can't believe it. Before I get into that, if you want to learn about how to spot those turning points, remember you can look at our website, trend-signal.com, and you can book in for a free trading webinar where we talk to you about the rules of those trading strategies, and you get in to learn a strategy that we use here every day. But look, what I want to do is get into, we're all set for the week ahead. Let's talk about a topic for today, which is the stock market ready for a crash? Just before I get into that, just going to do a quick poll. Just want to check on everybody's experience levels. Don't want to get too jargony, please, everybody. I'm just popping up a poll. So if you're on the live session talking right now, 12:30 or 12:54, whatever UK time today, Monday, let me know. Click on the screen there to click the poll, please, guys. So let me know, please, guys, how much trading experience you have. The reason I'm asking this question is it helps me know about how to talk. Really? Do I go mega jargon? Do I really cut the jargon back? All that sort of stuff. So let me know, please. I want as many people clicking on that poll as possible. How much trading experience do you have? Have you never traded? Check that box or click on it. Have you got, you have traded, but for less than a year. You've traded for between 1 and 3 years, and you traded for more than 3 years. That's great. Okay, let me close that off. I'm just going to share that to a bit of a mixed group today, to be honest with you. So I'm going to have to go a little bit jargon to non-jargon, basically. But look, what I want to do today is talk to you. It's about an indicator that I use. It's not an indicator as per what goes on the charts. It's something that can give you an indication over the value of the stock market and whether the stock market's due a fall or due a rise. Okay, it's going to be a little bit technical, but I'm going to try and break it down as simply as possible. Okay, so look, let me get into it a little bit. Let's talk about something called the VIX. I talked about it very briefly last week. Does anyone here know what the VIX is? Give me a yes or a no in that questions box, please. Do you know what the VIX is? Okay, lots of no's. I'm going to tell you what it is. Okay, so it's the CBOE's volatility index is a popular measure of the stock market's expectation of volatility implied by the S&P 500 index options. What the hell does that mean? Horribly technical, isn't it? But I'm going to break it right down. For all of us non-maths PhD graduates, it is commonly referred to as the fear index or the fear gauge. Okay, so the VIX is a market that is effectively, we call it the fear gauge. Okay, so the VIX concept works like this, guys. Okay, let me just go through. So the higher level of the VIX market basically means the more fearful that market is, the people that are trading that market is. The lower the level of the VIX market means the more greedy, the less fearful the market is. Why is that important? Well, it's important because it basically helps us with timing. What that means is when the VIX is very high, traditionally it means that the stock market is very, very low. People are fearful. People are panicking about stocks. People are talking and thinking, oh my God, the market's getting absolutely buried. Do you know what that is? That's the time to buy, the contrarian view. Typically, when everyone is panicking about stock, that's when you buy stock. When everyone's talking to you about how wonderful the stock market is, how it's only going in one direction and it's fantastic, it's all going to record highs, that's when you should be thinking about short selling stock or indeed cutting your portfolio a little bit. The contrarian view. And what I want to do is show you this, okay? So remember, the higher the level of the VIX means the more fearful we are. The lower the level, okay, means the more greedy we are. So let's have a look at what I mean by this. What I've got here is a chart of the FTSE on the top over the last 20 years or whatever, and I've got the VIX on the bottom. All of these spikes you see at the bottom here, let me just bring in my spotlight here, are spikes in the VIX, spikes in fear. Okay, do you see all those? Is that clear? Yeah, all these spikes are spikes in fear. So what that means is when the market is fearful, it kind of works a bit like a mirror to the stock market. And that's relevant because whilst the stock market can keep going on highs and lows or whatever, the VIX market has very natural support and resistance levels, okay? The reason that's important because it helps us with timing. If we can time how fearful or how greedy the market is, we can time the stock market, okay? The reason we can time it is because of its natural support and resistance levels. Do you see how there's like a natural level about here, isn't there? Do you see that? Okay, we had that big blowout back in 2008, 2009, but there's a natural sort of spike level there, isn't there? Now, over that time, you wouldn't say necessarily that the stock market has got a natural resistance level because, especially maybe on the FTSE a little bit, because it's been relatively flat compared to the US indices. But with the US indices, wow, let me just have a look at the US market and similarly. That certainly hasn't been flat over that time. Some fantastic movement over the last 20 years or so. But actually, look at that vertical line there. You see how we keep going to new highs and so on. And yet, the VIX has got those very, very horizontal resistance lines. Equally, when we're greedy, the VIX market is very low. Okay, and again, a very natural support level for that market. Do we see that as well, guys? Is this all clear? We happy with that? So you can see us moving against that tram line. So effectively, a tram line in this case of around 40 for major, major fear and around 11 or 12 for major, major greed, basically. Is this all making sense? So wouldn't it be kind of cool if we timed our portfolio buying or timed our trading based on where we are in the fear gauge? First of all, let's figure out whether this actually works or not. I'm going to put my cursor over each of these main points, okay? And I want you to think about how that translates. So you see and look at this spike here on 2002. That's when the market was mega fearful. That was the low, okay? It's hard to see because I've got to show a lot of the chart here. That was the low. When we were fearful, the market then rallied and had a massive rally, almost doubled in price, okay? That doesn't happen every time, but it certainly happened there. 2008. Okay, massive stock market crash. But you know what? The timing wasn't far off, was it? If you think about the end of that month, when we hit the peak fear, everyone's panicking. In fact, at the time, I remember people talking about the FTSE going to around 1,600. And yet, that was pretty much the low on the stock market. And of course, it's never looked back since then. We even saw a bit of a pullback there. Again, a bit of fear followed by a subsequent rally. Bit of fear, market fell. We hit our natural major resistance area on the VIX at 40, that horizontal level, which is very repeatable. And then we saw a massive rally on stock. Again, it happened here. Big pullback on stock. Doesn't look like a big one, but that is a big move. Big movement on stock identified by fear going through the roof. Everyone panicking. It's a good time to buy stock. And again, finally seeing it here, followed by another rally in stock again over the next 4 or 5 months. These may look like quite small moves, but they're huge. What I'm going to do is just move that down to a weekly chart and we can see that in a bit more detail. Okay, so we're looking back now over the last, 5 years or so. Let's just go through that same process. On a more micro level, 40 doesn't happen very often. What I tend to look at for this VIX is around a 30 level or a 20 level. Again, 20 or 30, anything above that 20 level means the market is in a real state of fear. And that's when it's interesting to start thinking about buying stock, okay? We're not in that stage, we're at the low level. But again, it's interesting for timing. Let me work out how. So what I want you to do is look at the vertical black line. See how it's matching from the top chart to the bottom chart. I'm going to look at this big low on stock here, okay? See how that's matching that big spike there on the VIX. That was back in January, the beginning of this year. The stock market was getting absolutely buried over the last few months of last year in the S&Ps, okay? Absolutely killed. But everyone now is thinking, oh my God, this stock market, it's getting buried. I don't want to be any part of it. Do you know what? That's not what I was thinking. I was thinking, wow, this is a fantastic opportunity to get long. If it goes above 30, it's usually the low in the stock market within about 48 hours. Occasionally it isn't, but it's usually the low within 48 hours. Believe me, it's insane. So what we then saw, having got down to that level, that high level of fear, everyone's panicking, oh my God, fine, I'll buy that stock back off you, no problem whatsoever. And a significant rally then took place on stock. We saw the same thing happen here, okay? See that low there? It went down to 25.30. See how much the market rallied from 25.30 up to 29.54. That was a 15% rally in stock. That's a big rally over the next few months. That's pretty big, right? If we could time that, that would help us with our portfolios, wouldn't it? And again, what we've seen there is again clearly identified by just a weekly touch of that 30 level. And again back here, touched it back at the beginning of 2016, marking out the low. That was the low point, that candlestick there, which was the highest spike in fear, and then the market rallied. So effectively, the more fearful this market is, the more better the timing it is for us to go long stock. That's typically the way it goes, okay? Is this making sense, everyone? Are you all still with me? Haven't confused anyone just yet? Okay, so good. Okay, everyone else, you still there? Good. Okay, so again, you can see that pattern repeat itself here. So when you saw again VIX touch the 30 level, that then led to that pull down in stock down to 1835. 6 months later, it's trading what? 15% higher again. Okay, and that's what? About 200. That's about 2,000, 2,500 points higher on the S&P. Significant rises, significant moves. Why is that attractive? Well, it's attractive because that's when people are dumping stock. Panic, 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 panic. So let's just move to the daily chart now. Okay, we'll move that to the daily and we can start to get a different picture and start moving through the time frames to help us with those timings again. So again, what I'm going to do is again look at those peaks. Look at the peaks. Very often you'll see it happen more on the daily. You get more opportunities at around 20. The big, you get like once a year maybe, you'll get it go into the 30s. You know, several times in the year you'll get it go into the 20s, okay, which can help you time when that market is really getting a bit killed, okay. The timing's not perfect. You see, when it got up here to around that 22 level, it was about here. So it did fall a bit more. So it's not perfect, guys, but it's a good gauge on where that market is positioned, okay? It really can help us with that timing, with that element there. Interestingly here, do you see there? We went above 20s. 20s for me is a big consistent level. 3 or 4 times throughout the year, you're going to get the VIX move up to around that 20 level to give us that opportunity of fear again. And we saw it again. That led to movement in stock. That's not to say you buy stock just because we hit that 20 level, but you need to be thinking about it. If you've got a portfolio, or indeed if you are, maybe you are thinking about buying a stock market, buying an index, that's fine. Wait for your entry, you know, wait for your strategy to confirm the trade. But what it's doing is adding weight, it's adding confirmation that it is the right time to get into it, okay? So just making it more attractive for you. Again, similarly, we can zoom in, big sniper buy trade here back in January. What made this one so attractive? Why did it go up so much? Because we were bloody scared at that point. Market was absolutely, excuse my French, crapping itself. Okay, that's what made then the big rally on higher. Okay, and again, similarly, big rally. May not look like a lot, but over the next few weeks, big rise in stock. Big rise in stock on those charts there. Again, guys, we still okay? Still making sense? Okay, so that's fine, but look, we're the other way round at the moment, aren't we? We're not in a position of fear right now. We're in a position of greed. What's happening now is the exact time of the market when your nan calls you up and says, hey, Adrian, I see the stock market's doing really well right now. Is this a good time for me to buy some shares? And I'll say, brilliant, Nan. I'm going short. Fantastic. Because my Nan is going to be the last person to enter the market. She's going to be the last sheep, bless her heart. Okay? So that's when I know that the market is so complacent. The market is so running on a lack of fear. All we're thinking about is this wonderful stock market and how much rate's going to go up and up and up. Actually, that's the time. That's the time to be considering the market reversing and changing direction. Okay? So how can we read that? We know if the VIX is quite high, that means the market is fearful and we're due a rise in stock. But what about the other way around? Well, it's going to be if the VIX is low, it's like a mirror, okay? You could almost put a mirror across these two charts and you can see the opposite, okay? It's fallen to a support level, absolutely. What level? Well, let's have a look. If that market leads to usually around 11, something like that, it goes through different phases, guys, okay, but around about 11, and it's, you know, that means usually that the timing is due for a bit of a pullback. We haven't quite hit 11 here yet, okay? We went down to exactly 12 dead today, Friday, but we might see it rise up to through 11s today, 11 nines or something like that. But here, we went down to 11 here. We translated to that high in the stock market. Here, which was about here, okay, and we just get that cursor on there. Okay, not perfect, but you know what? It led to a big fall. There, led to a big fall. And the next one, see that? Hit those lows. So the low on the VIX there down to about 11.6, 11.3, sorry. The low there down to what, 11.03. The low down to what, 11.6 again. At the moment, we're not quite in the 11s yet, but we're getting there. Okay, so why is that relevant? Because when you hit those natural support and resistance levels, flat horizontal levels on the VIX, it can help us with the timing of support and resistance on those index markets. Okay, are we due a massive fall? I don't know. Look, we're going to have to see. We're going to have to see, aren't we? But history would suggest, and all technical analysis is patterns repeating itself. History would suggest that when we hit these levels, go back to the weekly there, when you hit those levels, that's when you see a correction in the market. Not always, but often, okay? And again, if we just put it up on the monthly, you can actually probably see it a little bit better on the FTSE. Historically, the VIX has been a much better correlation against the FTSE than the VIX, but than the S&Ps. But certainly, you can use that level. It's not perfect, guys. Look, it might hug along this level for a little while, okay? But it can help us with that timing. Effectively, to me, what I find is it may not be the best time up here to be buying a portfolio of stock or loading up. What I might be more interested in doing is reducing my holdings down, okay? Cutting back on the more volatile stocks, your mining stocks, your banking stocks, your technology stocks, on the basis that maybe that's when, you know, they're the ones that usually come off faster. So you cut on those, you move into your defensives, expecting a bit of a pullback, and then you can load back on your aggressive stocks, your high beta stocks a little bit later on, okay? Just a thought. What's going to happen? I don't have my crystal ball. We'll find out over the next couple of weeks, everybody. But certainly, from a very overbought market right now, in a situation where the VIX is as low as it's been, and the relationship that we've had with that this year would suggest that we're in a time that's quite interesting for the stock market. Okay, so that's it really. So Andre, so now it really is about following the news and the calendar to get a sense about when the move is going to start. Correct. Okay. Everything's translated onto the chart, Andre. You don't actually really need to follow the news because it all comes up on the chart anyway. What the news does is it gives you an indication of when something might actually happen. So in other words, what the catalyst might be. The bigger data announcements are more likely to be a catalyst of a change in direction than anything else. So therefore, if you know when the big catalysts are likely to come, where the big banana skins are, you know how to trade accordingly. You know what to be aware of and so on. So that means if there's, say, an interest rate decision for the US next week, it's good to know about it because it could be quite important. Okay? You don't have to know are we expecting a rise or a fall or whatever? You just need to know that it's happening, that the event is going to take place. Okay. Can this be done intraday? Yeah, sure. People can trade intraday using the VIX in that way, less so because you don't get the changes like that, so it'd be less relevant there. But of course, trading intraday, looking at those those tops, those bottoms, and so on, is pretty straightforward if you've got the right tools and techniques. And in fact, one of the training programs that we run is purely about intraday day trading. Kenneth. So it's just about, really having a style that best suits you. So we have end of day trading programs, we have intraday trading programs, and it's all about what best suits you and your sort of day-to-day lifestyle ultimately. Okay, so that's it for me. I'm not going to talk about projections or how far I think the stock market might fall, if indeed it does. What I'm saying to you is keep your pencils sharpened. Okay, historically it's led to quite reasonable sized falls. I actually am a longer term bull of the stock market personally, and I am so because of the way interest rates are right now, and the way the stock market is as attractive as it is. However, that doesn't mean that in order to make the new highs that we're not going to have an inhalation and inhale, stocks pull back in order to exhale and then push on new higher and so on, everybody. Okay, we shall see in the mists of time, won't we? But guys, that's pretty much it for my podcast. If you want to give me some feedback, that will be fantastic. There is an exit survey for the live session, so as soon as you close the event, you'll be asked a couple of questions there. Pop it in there, give us some feedback. That'd be fantastic. The other thing you can do, everybody, is also register for one of our live trading webinars where we talk about one of our trading strategies that actually identifies the turning points and the trading opportunities themselves, more of the practical application side of it. If you would like to register for one of those events, then just simply find yourself at trend-signal.com and you can register for a webinar on that page there. Okay, if you'd like to have a look at the VIX, some platforms offer it. You could also search for the hats, or what's it called, Circumflex or Circumflex, whatever, VIX on Yahoo Finance. So that's finance.yahoo.com, and you can get the VIX price on there. So that's that little hat symbol, Shift 6 on your keyboard with VIX following that there. Okay, all the best, guys. Let us know what you thought about it. You can fire that into the questions box if you want to, any feedback or whatever. But otherwise, I'll be back with you next week. Jerry's going to be with us next week as well. He's back from climbing to base camp in Mount Everest. Base camp, that makes it sound like he hasn't climbed very high, but he actually really has. So I suppose he'll tell us a little bit about his antics when he comes in for next week's podcast there. But otherwise, guys, have a wonderful week's trading, won't you? And I look forward to catching up with you next week there.